Well, it's tax time again. Every year around this time, people start stressing out. The moment your accountant calls, your first thought is, oh no, here comes the debt collector. How do I owe this much again? Income tax, capital gains tax, land tax, there are over a dozen different taxes to deal with. In Australia, the marginal tax rate on personal income, including the Medicare levy, can go as high as 47%. That means almost half of what you earn goes straight to the tax office. For the average salary earner, there really aren't many ways to reduce tax. But for wealthy Australians earning over $1 million a year, some of them don't pay a single dollar in income tax. Why is it that rich people can pay no tax while the rest of us worry about tax bills every single year? Because the rich don't just know how to make money, they also know how to keep it. I graduated with a master's degree in accounting from the University of Sydney. After that, I worked as an accountant for 3 years and then started my own business. I'm also a stock and property investor. While I may not have decades of experience as a veteran accountant, in practice, I've developed and refined several powerful legal tax strategies. And today, I want to share them with you. If you hate handing over your hard-earned money to the tax office, then you absolutely need to watch this video to the end, because I'll be breaking down 7 legal ways to pay less tax or even no tax at all. Learn these strategies and you too can start keeping more of your money just like the wealthy do. Because this is a property investment channel, I will talk more about tax savings on properties. Hi, I'm Alex. Welcome to Oz Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. Number 1. Stop earning paper income. This might sound surprising, but it's actually one of the most common strategies used by the wealthy. In Western countries like the US and Australia, the tax office collects taxes based on what's called your tax base, and that tax base is your income. So if you can legally show the tax office that you have no income, then you owe no tax. Now, if you're an employee, it's impossible to claim you have no income. Your pay slips are crystal clear. But the wealthy, they don't make money by earning wages. They build wealth through business ownership, investments, and holding assets. A regular worker's tax base is their salary, and income tax is taken out before they even receive their money. Then they use their after-tax income to pay for everyday expenses, which are taxed again at 10% GST. But if you run a business, it's totally different. Your tax base isn't your revenue, it's your net profit after expenses. If your business earns $100,000 and spends $100,000, then your taxable profit is zero. So guess what? You pay no tax. See the difference? Workers pay tax first, then spend. Businesses spend first and then only pay tax if there's profit left. If you own a company, you'll know the routine. Near the end of each financial year, your accountant will probably tell you, go spend some money, buy a car, buy a laptop, get that designer bag, book a business trip, buy some work suits, enroll in a course, all in the name of tax deductions. As an employee, you might still need to buy all those things, but if you pay through your business, they become tax deductible. They reduce your taxable income. But here's a powerful trick. Set up a company, channel your income through that company. Instantly, you open up access to a world of tax strategies and deductions. Cars, properties, investments, and business revenues done through a company can all legally reduce your tax. But if you're just an employee, your tax options are incredibly limited. Number 2, tax deductions. The smartest move? Hire a professional accountant. A good accountant doesn't just lodge your tax return. They find every deduction possible to reduce how much tax you pay. If you run a business or work as a contractor, it's like opening the door to a new world of deductions. You might already know the common ones, so let's talk about the less obvious ones. Briefcases for carrying laptops or tablets. Yes, even women's handbags. Internet bills, phone bills, and productivity apps on your phone. Hats, sunglasses, and shoes needed for outdoor work. Bank transaction fees, water, gas, electricity, internet, rent if you work from home. Office supplies, tech gear, cameras, and magazines. Training costs and car-related expenses, all of these can potentially be claimed as tax deductions. Now, if you're just a regular employee, your options are limited, but it's still worth checking the ATO website for what's available each year. Maybe travel expenses, commuting costs, or fuel deductions are on the list. Sure, these aren't huge amounts, but hey, every bit helps. Number 3, superannuation contributions. Beyond deductions, another powerful tax-saving tool is superannuation, your retirement fund. Australia's system is unique. For the 2024 to 25 financial year, employers are required to contribute 11.5% of your salary to your super. When I helped Vision members review their finances, I was always shocked to see how different super levels were across industries. University lecturers, for example, get over 20% employer contributions. That's incredible. Most jobs don't offer that much, but you can still make extra super contributions from your pre-tax income. This is called salary sacrifice. And because it's taken before tax, it goes into super at a flat tax rate of 15%, much lower than the top marginal tax rate of 47% on personal income. That means any income you contribute to super is only taxed at 15%, and from there, it can be invested securely for long-term growth. Now, if you're self-employed and have never paid into super before, but this year you made a big profit, maybe from your business, selling a property, or cashing out shares, then you should seriously consider opening a self-managed super fund. Here's why. You're allowed to catch up on up to 5 years of missed contribution in one go. This reduces your taxable income now while boosting your retirement fund for later. Super is the lowest taxed investment vehicle in Australia. Capital gains tax is only 10%, income tax is 15%, and once you hit retirement age, even those become tax-free. Number 4, family trusts. Apart from self-managed super funds, setting up a family trust is another powerful tool for legally reducing taxes. You can use the family trust to hold investment properties, businesses, or shares. The income generated can be distributed to beneficiaries. For example, if a couple and 2 kids are in the same family trust, and the kids have no income, more of the trust income can be allocated to them. Why? Those kids with no income fall under a lower tax bracket, which helps to lower the family's overall tax burden. But tax savings are just the beginning. Family trusts can also help you increase borrowing power, protect your assets, and pass on wealth more efficiently. Number 5, property investment. In Australia, no matter what the government says publicly, it has always supported property investment, both openly and behind the scenes. Why? Number 1, it boosts the housing supply and fuels the construction and related industries. Number 2, it increases rental stock, helping ease the rental pressure. Number 3, tax-wise, property gets more favorable treatment than most other investment types. Let's be honest, this is a clear encouragement to invest in property. And for high-income earners, this is the single most effective way to reduce taxes. No other strategy comes close. Here's an example. Suppose you buy a $1 million investment property with an $800,000 mortgage at a 6% interest rate. The property rents out for $40,000 per year. But remember, you're not actually earning $40,000. There are expenses to deduct, such as interest, management fees, council rates, water maintenance, and insurance. With current high interest rates, it's easy to run at a loss, say a $3,000 loss per year. Now, here's the kicker. If it's a new property, the depreciation in the first few years can be around $17,000 annually. When you do your tax return, let's say your salary is $120,000, but you've now got a $3,000 rental loss and $17,000 in depreciation. Your taxable income is no longer $120,000, it's $100,000. That could save you $6,500 in tax, which means your $3,000 loss actually turns into a $3,500 gain. This is called depreciation. Think of it as a government incentive to support property investors. Now, some people might jump in and say, you'll have to add that depreciation back when you sell. Well, yes and no. Not all depreciation has to be fully added back, and how it's added depends on the type. But even so, the tax you save today can be reinvested, and thanks to the time value of the money, that can be far more valuable than not using it. So not only do you save tax, but your property also increases in value. That's called appreciation. Let's say that $1 million property grows to $1.3 million after a few years. You can go to the bank and refinance up to 80% of that new value, $1.04 million. Pay off your original $800,000 mortgage, and you are left with $240,000 in cash. This is refinancing. If you don't need the cash immediately, you can park it in an offset account to reduce interest. But if a great investment opportunity comes up, something with a higher return than your mortgage interest, you can act fast. Maybe you'll buy another property, maybe invest in the business. And if you hold your investment property under a company structure, the company's profit can be used to pay interest. And surplus profit can go directly toward repaying the mortgage. That's amortization. So in summary, property investment is one of the best ways for everyday Australian to reduce taxes and build wealth. Now that we've covered common strategies, let's talk about 2 lesser known but incredibly powerful ones. Number 6, offshore tax strategies. Let's talk about what we often call tax havens. Many multinational tech companies use them. You ever wonder how companies like Google and Apple pay so little in taxes? Sometimes they pay even less than you do. Here's a simple example. A sportswear company operates in the US and generates $200 million in profit after expenses. However, the trademark it uses is owned by a company registered in the Cayman Islands. Coincidentally, the annual royalty fee for that trademark is exactly $200 million. So the US company pays $200 million to the Cayman Island company, and just like that, the US profit drops to zero, meaning there's no US tax. And in the Caymans, there's no tax at all. That's offshore tax structuring in a nutshell. But what about regular people, small business owners, or entrepreneurs? It's about finding developed, business-friendly countries that support entrepreneurship and allow you to operate freely. Take Singapore, for example. Australia's corporate tax rate is 25%. In Singapore, it's 17%. And for new companies, it's even lower. The first 100,000 Singapore dollars is taxed at just 4.25%. The second $100,000 at 8.5%. Above $200,000 is taxed at the standard 17%. This brings the average tax rate on the first $200,000 to just 6.38%. Even for companies over 3 years old, the average rate remains low, around 8.29%. For personal income, Singapore's top marginal tax rate is 22%, far below Australia's 47% and America's 37%. And if you reinvest your earnings, say, into shares, there's no dividend tax, no capital gains tax. Is Singapore the best? Not necessarily, but if you're willing to do some research, you'll find the right combination of country plus entity that suits your strategy. Number 7, financial education. And finally, this is the most important of them all, financial education. Why do so many people give up before they even start a company? Why do most never consider tax planning at all? Because they're stuck in their comfort zone. They're scared of change. They don't believe they're capable. They assume it's only for rich people. To overcome this, you need to read books that inspire you. Watch financial literacy seminars. Surround yourself with people who've done it. You never learn how to legally reduce taxes in school because governments and the wealthy need your tax dollars to fund the system. We've covered a lot, so let's do a quick recap. For everyday Australians, what are some of the most common and accessible tax reduction strategies? Number 1, claiming deductions for work-related expenses. Number 2, claiming deductions for accounting and legal services. Number 3, making pre-tax contributions to superannuations, including salary sacrifice. Number 4, purchasing private health insurance to avoid the 2% Medicare levy. Number 5, buying investment properties to benefit from the 50% CGT discount and negative gearing. Number 6, setting up a self-managed super fund to invest in property with the lowest tax rate. Number 7, using a family trust to spread income and lower the overall tax burden. Number 8, registering a company structure for side income to reduce the total tax rate. Now there's one more thing we haven't talked about. Is tax minimization moral? Let me put it this way. In Australia, the tax office is the least friendly when it comes to individuals and small businesses. There was a documentary aired by the ABC News Australia where several former senior ATO staff exposed the internal workings of the ATO, and what they revealed was shocking. They said the ATO operates just like a business. There are revenue targets, yearly, monthly, weekly, even daily, handed down to departments and frontline staff. ATO employees are under pressure to meet those quotas. And that pressure is passed on in the form of more audits, more penalties, and more debt collections, especially targeting individuals and small business owners. The result? That pressure can push ATO actions beyond their legal boundaries. One small business owner featured in the documentary said he'd been fighting the ATO for years over an unjust tax debt. He described it like having 2 full-time jobs, one for running his business and looking after clients, and the other just to deal with the ATO. So why does the ATO go after individuals and small businesses? Because big corporations have legal teams and the resources to fight back. But most individuals and small business owners don't have that kind of protection. Here's my takeaway. The ATO is not on your side, not on the side of everyday Australians, and definitely not on the side of business owners. I don't know if anyone still thinks paying taxes is a badge of honor, but I can tell you I definitely don't. Every legal and reasonable deduction you're entitled to, take it. Every cent counts. And make sure you hire a good accountant to keep your books clean and defendable. If the ATO ever comes knocking, you want to be confident, clear, and well prepared. You want to be able to push back with just a few facts, not get dragged into expensive legal battles that waste your time and energy. If you're interested, go check out that documentary. It'll open your eyes and completely change the way you see the system. If you've made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos. And have a good one. Bye.